A banker can read your bank statement in 30 seconds. Most customers cannot read theirs in 30 minutes. That is not because the customer is doing anything wrong. Nobody ever taught them what to look at first. There are a few specific things a banker scans for. None of them are what most people look at. One is a small charge, $2, $3, that does not belong. Another is a number that is suspiciously round. Another is something that should be on the statement and is not. Today, I am going to walk you through what I look at, in the order I look at it. The average household pays around $380 a year in bank fees they could have caught on a statement. Let us go through what to see. Before I go further, two things straight up. The first is that I am not your banker, I am not your attorney, and nothing in this video is personal financial or legal advice. I spent 20 years in banking. I am going to teach you what a banker looks at on a statement. What I am not going to do is tell you what to do about your specific account. Every bank, every account agreement, and every situation is different. If you think you have an actual unauthorized charge, you call your bank directly, you put it in writing, and you read your account agreement. The second thing is Regulation E. Regulation E is the federal rule that covers electronic transfers, debit card charges, ACH pulls, online transfers. The rule sets time windows. 60 days from the day your statement was sent is one of those windows. The exact protection you get depends on the situation. I am going to explain the general idea of that 60-day window later because most people have never heard of it. I am not going to tell you what protection applies to your account. For that, you need your bank and, if it is serious, an attorney. Now, let us read a statement. The first thing a banker scans for is the small charge, not the big one. The small one. Somewhere between 50 cents and $4 from a merchant the customer does not recognize. Most people look at that and assume it is a mistake or a fee they forgot about. A banker assumes one thing first. The card is being tested. Here is how the pattern works. A person with stolen card information runs a tiny charge first. They are not trying to steal $4. They are confirming the card is live and the bank is not blocking the merchant. If that small charge goes through and does not get disputed, the real charge comes later. Sometimes days, sometimes weeks. There is one tell that separates a real test charge from a normal merchant authorization hold. A normal hold appears and then disappears, usually within a few business days. A test charge stays. If the small unfamiliar charge is still on the statement at cycle close, that is the one to chase. The one that briefly appears and then drops off is almost always just a hold. The rule is simple. Tiny charge that clears off, likely a hold. Tiny charge that stays, call the bank. The second thing a banker scans for is round numbers. Real spending is messy. A normal grocery trip is $43.71. A normal tank of gas is $52.18. A normal coffee is $6.04. Real life produces decimals that are all over the place. What does not produce messy decimals is a subscription. A subscription is $9.99 or $14.99 or $19.99 or $4.99, clean, repeating, often the same day every month. Forensic accountants have a name for the pattern when numbers that should be messy are suspiciously clean. The consumer version is simpler. If your statement has a column of recurring round number charges, those are almost never groceries or gas. Those are services. Some you signed up for, some you forgot about, some renewed after a free trial you tried 2 years ago. A banker scans for the clean numbers because the clean numbers are where the silent money is. The average household has at least 3 recurring charges they do not actively use. Find them, and you find money that was leaving every month without anyone deciding it should. Here is the part most people have never been told. When most people read a statement, they scan for things that arrived. Charges, withdrawals, fees. A banker scans for things that did not. This sounds backwards, so let me give you the list. Did the interest credit post this month, and is it the amount you would expect from your average balance? Did the direct deposit hit on the day it was supposed to, or did it land late? Did the autopay you set up actually pull, or did it silently fail? Is there a pending hold on the account that you did not put there? Is the recurring deposit you receive every month smaller than last month by an amount nobody explained? Banks do not make money on the loud failures. Banks make money on the silent ones, a direct deposit that posted a day late and triggered an overdraft, an interest credit that quietly stopped because a rate tier requirement changed, an auto pay that did not pull and led to a late fee on the other end. None of those things show up as a line that says something is wrong. They show up as an absence. So once you have scanned for the small charges and the round numbers, run the second pass. Look for what is not there. A few years into my time at one of the branches, a long tenure deposit customer came in to renew a certificate of deposit. While I was pulling up her checking, she stopped me. She pointed at a charge on her statement, $2.79 every month, from a merchant descriptor she did not recognize. It turned out to be a free trial she had signed up for over a year earlier and never canceled. About $35 over 12 months. Then I noticed something she had not. A $6 paper statement fee that should not have been there. Her account had been migrated 4 years earlier into a tier that did not charge for paper statements. The fee never came off. We canceled the trial on the spot. The paper statement fee we requested as a goodwill refund, and the bank issued a credit for the prior 24 months. Total recovered was a little over $300. What stuck with me is that she was not careless. She read her statements every month. She was reading them for the transactions. She was never reading them for the fees and never reading them for what was missing. The third pass is the one most people are already doing, but doing wrong. The fees. Throw out what you thought you knew. The bank fee landscape changed significantly in the last 2 years, and most statements quietly reflect that change without telling the customer. Maintenance fees, where they are still charged, average roughly $16.35 a month at large banks and $10.95 at smaller institutions. Overdraft fees are more complicated. At the largest banks, the typical overdraft charge has dropped to somewhere between $5 and $10, or in some cases, zero. At smaller community banks and credit unions, the older $25 to $35 fee is often still in place. What that means for the scan is this. If you have not looked at the fee section of your statement in the last 12 months, assume the structure is not what it used to be. Some fees are quietly higher, some are quietly lower. Some are quietly new. Paper statement fees, inactivity fees, account research fees. A banker compares the fee column to 3 months ago and looks for what changed in either direction. According to recent federal consumer finance data, an average household that overdrafts frequently pays around $380 a year in fees alone. Most of that is recoverable through a single phone call if it is caught within the cycle. The catching is the hard part. The asking, when you have a real reason, usually is not. The fourth pass is timing, specifically when on the calendar a suspicious charge showed up. Fraud is not evenly distributed across the week. The pattern bankers see is a concentration from Friday evening into Sunday afternoon. There is a practical reason. Dispute teams operate on reduced hours. Fraud monitoring response is slower. The person whose card has been compromised is more likely to be away from a computer, on a trip, or out with family. The thieves know all of that. When I scan a statement, anything dated on a Saturday night or Sunday morning that the customer does not immediately recognize gets the closest look. Not because weekend charges are automatically wrong, because weekend charges from unknown merchants are the ones most likely to slip past until Monday, and Monday is sometimes too late to catch the second wave. The practical move is simple. Pick one morning a week, Monday works for most people, and run a 5-minute scan of the prior week. You are looking for the weekend lines, Friday night to Sunday afternoon. That is the window where the test charges land. There is one more thing on the statement worth knowing about, and I am going to keep this part general on purpose. The federal rule that covers electronic transfers, debit cards, ACH pulls, online transfers, is called Regulation E. It is found in Title 12 of the Code of Federal Regulations, Section 1005.6. The rule describes a 60-day window. The thing most people do not know is that the 60 days does not start when the customer notices something. The 60 days starts on the date the bank sent the statement that first showed the issue. The statement date is the trigger. The rule itself describes different outcomes depending on when notice is given and what type of transfer is involved. Those outcomes are not for me to apply to your situation. What I am telling you is that the trigger date exists, and the trigger is on every statement you receive. What that means for your money is something only your bank, your account agreement, and if needed, an attorney can answer. What I want you to take away is much simpler. Look at the statement date. That is the date the clock starts on. So, here is the 30-second scan in the order a banker runs it. First, any tiny unfamiliar charge that is still sitting on the statement at cycle close, not the ones that came and went, the ones that stayed. Second, any clean round number charge that repeats, especially anything ending in 99 cents. Third, the fee section. Compare it to 3 months ago. Look for what changed in either direction. Fourth, what is missing? The interest credit, the auto pay pull, the on-time direct deposit, the expected recurring amount. Fifth, the weekend lines. Friday evening through Sunday afternoon. Charges you do not immediately recognize. Sixth, the statement date itself, because that is the date the trigger clock starts on. 6 items, 30 seconds, once a month. If this was useful, pull up last month's statement tonight, set a timer for 30 seconds, and run the 6 items in order. The natural next step is the other document most people read wrong, the one that affects almost every loan you will ever apply for. I made a banker's walkthrough of how to read your credit report the same way I built this one. The link is on the screen. If you found this helpful, share it, drop a comment, and subscribe. And remember, your bank statement is not a record, it is a map. The fees, the patterns, and the missing things are how a banker reads it. Now you do too. I will see you in the next video.